Okay, so I'm going to combine chapter 16 and 17. We're going to talk about budgets. There's not a lot in chapter 16, but there are a few things. We talked about budgeting, and there are human characteristics in the budgeting. I talked about how times you're paid based on whether you achieve your numbers or not. And there are some people that always seem to hit their numbers. Um, I refer to that as sandbagging, but it's also called budgetary slack. So they purposely put in numbers that they're pretty sure they're going to achieve. The budgets all begin with, of course, the sales budget. And we saw that where everything is dependent upon the sales budget. The sales budget will determine how much of the product we're going to need to purchase and how much we're going to need to sell. The sales budget will determine how many people we need to sell the products that we intend on selling. The operating budget, of course, is all of the different budgets. So it would be if you're manufacturing, it would be the raw materials budget, the working process budgets, all of the different budgets that are involved. Um, I'm just kind of reviewing the test here, so bear with me for just a minute. All right, so anyway, there wasn't a lot in chapter 16, but you should review your budget project because you can't expect a problem where you have to predict the sales volume 2 quarters down the road. It's not that difficult. You just start with X, you add the increase from this quarter, you then add the increase from that quarter, and that should be your answer. So it's fairly simple math. I also want to bring up the chapter 15. You should be aware of the impact of changes. Remember, I referred to the overhead as the jar. So as the jar increases, it means that you're going to need more units to break even. So as your fixed costs go up, that means that your break even is going to increase as well. As your fixed costs decrease, it means that your fixed cost or your break even volume will go down. And so the other item, of course, is the contribution margin, and that's the marble. So the size of the marble is depending upon the contribution margin. To increase the contribution margin or the size of the marble, you have to do one of two things. Either you increase the sales price or you decrease the variable cost. Both of those will increase the size of your marbles, which will decrease the number of break-even units or the number of units you need to make a profit. So we moved on to chapter 17, and this is about flexible budgets and standard cost system. I mentioned that auto manufacturers or anyone in manufacturing, they do a lot of tests, and why don't we go to that? Let me pull up chapter or number 7, chapter 17 here. All right, so we talked about um, flexible budget systems, which means that we project what we should have made at that volume level instead of just a static budget where we say, okay, think we're going to do 50,000 units. We think we're going to make this profit. If we exceed the profit, we're good. If we don't meet the profit, we're bad. Should know, some of the impacts on these. So basically, if you exceed your revenue, that is a um, positive. If you are below your expenses, that's also positive. If your revenue is below your budget, that's negative. If your expenses are more than your budget, that's negative. Favorable, unfavorable. Favorable if actual amount increases operating income. And then again, we talked about this and we said, well, a flexible budget means that we predict what we should have made at those different levels instead of just saying, well, we exceeded the budgeted profit, so we're good. And we talked about these different variances and we went through and determined how we could really zero in on what the issue was. We talked about the standard as the price, cost, or quantity that is expected under normal condition. Standard cost system is an accounting system that uses standard for product cost. We talked about this. So, who makes these decisions on the cost standards and the efficiency standards? The cost standards is how much did we pay compared to how much we thought we would pay. Efficiency standards is how much did we use compared to what we thought we would use. And you can see here that direct materials is decided by the purchasing manager for cost. Direct labor is the human resources manager for cost. And manufacturing overhead is the production manager, and that depends again on the sales budget because we have to have the manufacturing capability to produce what we budget. Efficiency standards would be the production manager and engineers. So again, they're going to look and examine how long it takes to do something, and that will be the standard. Same thing for direct labor. We are going to separate this into a cost variance and the efficiency variance. So what we're going to do is really look at the per item cost, and we're going to compare that to the actual volume that we used. In this case, we had 35 cents compared to 32 cents. So we saved money, and how much we saved is dependent on how much we produce. So since we saved 3 cents per unit, it's okay. So direct material cost standard was 35 cents. Direct material efficiency standard was 5 pounds. So we thought it was going to cost us $1.75 per batch. You should be able to look at this and say, okay, just off the top of my head, I can figure out whether there is a per pound variance. You multiply, or we paid $104,000, we divide that by 325,000 pounds, and we paid 32 cents. So we should know right off the bat, just by determining, comparing the price per pound with the budgeted cost, uh, that we were under budget or favorable as far as the price. And then we can just look at how many units we used, and it's 325,000 pounds. Okay, and so 325,000 divided by 52,000 pounds is what we used. And we can see that we use 6.25 pounds of paraffin. So we know that that's going to be unfavorable. So you should be able to just do those two quick computations. One, determine what the price per pound was, and in this case, it's just what we paid divided by the number of pounds, and then how much we used. We used 325,000 pounds, and we made 52,000 units, okay? So we're going to go through and look at this, and you can see again, we paid 32 cents, we budgeted 35 cents, we used 325,000 pounds, so we had a favorable budget due to cost. But we had an unfavorable budget due to efficiency, so we used more than what we thought. So we used 325,000 pounds. We should have used 260,000 pounds. We multiplied that by the cost that we budgeted, and this was an unfavorable of 22,750. We talked about what could cause that, and some of them could be machinery, it could be unskilled workers, or it could be a bad product that we got. And then we went on and talked about the direct labor variance. And again, same thing here. We used $12 per hour as our labor cost. We used a quarter hour per batch. And so we can just look and go again, 52,000 batches. What should we have used? 52,000 times 0.25. We should have used 13,000. We used 10,400. So right off the bat, you should know you have a favorable efficiency variance. But then what did it cost us? Well, 145,600 divided by the number of hours, 10,400, and that gives us $14 an hour. So we know that since our budget is $12, that's going to be unfavorable. But then when we did the calculations, we determined that the unfavorable cost variance was more than overshadowed by the improved efficiency variance. And then when we looked at all factors, we determined that the unskilled labor really shouldn't be an example or a reason why we used more paraffin. So I think it came down to we either had a machine malfunction, which is something we can easily determine, or we had a bad product, an inferior product, which we then need to go and change. All of this was related to being able to answer questions, and whether it's whatever industry you're in, you can use these tools to break it down to determine the root cause. And so you can go that and look at the final details here, and let's see what all the different variances here. So total product cost budget variance was favorable by 7320. Unfavorable materials, favorable labor, favorable overhead. But then I caution you that the overhead is allocated again based on direct labor hours. That's something I didn't point out, but again, we are going to estimate the total amount of overhead we have. We're going to estimate the total amount of direct labor hours we have. And then we're going to use that to apply and to allocate these indirect manufacturing costs to the product. So in this case, because we used a lot less hours, we're allocating a lot less manufacturing overhead. But that may not be the case. So you should be very familiar with this, as I mentioned. There are going to be questions, what could cause this? And so you should be familiar with it. You should just think, what could cause this? And those are all the journal entries, but we're not going to do that. So I think that wraps up the review. If you go over these three different videos, and you know this material, then you should be well prepared for the test. Since we don't have a class anymore, I just would like to wish all of you good luck in your future academic and professional careers. I hope you learned a little bit about companies, about public companies, and I would like to emphasize one thing, that I started the class off telling you how to make $1 million, and that is possible. So if you were to get a job, let's say, and you're making $50,000 a year, and so most companies that I have dealt with, they will match up to 3% of your salary, or they'll put in 50 cents for every dollar you put in, up to 3% of your salary. So when you start working, you graduate and you get the job that you want. Let's say you make $50,000 and you put in 6% of your salary, so that's $3,000. And then the company is going to match that, and they're going to put in $1,500. So you're going to put in $3,000, and the company is going to put in $1,500. So that's an immediate 50% return. So if nothing else, you should max out your 401k to get the maximum company contribution. Now, because of taxes and because these are pre-tax dollars, they're going to take out, or that $3,000 is not really going to cost you $3,000 because you're not paying taxes on that amount. So let's say that you're in a 15% tax bracket. That means that it's really only going to cost you 85%. So 85 times 3,000 is, well, 0.85 is 2550. So for 2550 out of pocket, you're going to get 4,500 contributed to that 401k. If you start when you're 30 and you work until you're 67 and you get the 7.5% return that the market has provided over the last 100 years, then you'll have $800,000 when you're 67. That's not quite a million, but let's assume that you just continue to have that 6% taken out and you get raises that are higher than the cost of living because you're progressing. That amount that you're contributing to the 401k and the amount your company is going to contribute to that 401k will continue to increase. So if you were to only do this, to only max out your 401k contribution, then you will hit that $1 million in today's dollars. And so when you do that, I want you to think of me. Again, I wish you all luck in the future.